Bill, I do want to start off here with the idea of the market reaction to what we've learned over the past couple of weeks from the Fed minutes this week and, of course, from some of the commentary out of Jay Powell towards the end of December here. Do you think the market is believing right now that the Fed is going to be aggressive in its rate, or I should say, with regards to its monetary policy tightening?
I think the market thinks the Fed is going to be sooner than what they thought. The tightening probably is going to start at the March FOMC meeting, which is much sooner than we thought, say, a year ago. But I don't think the market is yet of the view that the Fed's going to be really aggressive. If you look at the Fed's own forecast, they only see, the median forecast only sees the federal funds rate getting to 2.1% at the end of 2024. And if you look at Eurodollar futures prices, they're roughly in the same sort of ballpark. My own view is that the Fed's going to have to do a lot more than that. I mean, I think what we're seeing is more and more evidence that the Fed is way behind the curve in terms of removing policy accommodation. The unemployment rate today fell to 3.9%. Inflation's running over 5%, and wages are accelerating. Yet the Fed is still adding stimulus by buying assets, and that's not going to be wrapped up until March.
So from your perspective, the terminal rate goes higher than 2.5%. If they're going to have to do more, will they be able to look down the barrel of tech shares selling off hard, the market being a difficult force for them, but be able to hike through it and still preserve economic growth?
Well, I think the real question is what you've raised, is how is the market going to react to the Fed tightening? Last cycle, the market was quite sensitive to Fed tightening. That slowed the Fed down. But the Fed was slowed down at the end of the day by the fact that the inflation never actually materialized. That's the fundamental difference from the last cycle. You go back to the previous cycle, hiking cycle, 2004, 2006, the Federal Reserve had to tighten a lot. They tightened 17 consecutive FOMC meetings, taking the federal funds rate from 1% to 5.25%, precisely because the market essentially ignored what the Federal Reserve was doing in terms of tightening monetary policy. So I think you are focusing on a key issue. How does the market respond to what the Fed does? Now, at the end of the day, the Fed doesn't care about the markets themselves. They care about how the markets affect the economy. So my own personal view is that the Fed is going to have to tighten enough to tighten financial conditions, push down stock prices, push up bond yields. And I think what's happening today, this week, is the markets are starting to get the first sense of that. But this story has just started. We're not anywhere near the end of this.
Can we talk more about the comparisons to previous cycles, namely balance sheet normalization in the runoff, where there was a discussion as well that normalization this time around could happen shortly after the first rate hike, where last time, I think between 2015 and 2017, it was almost 2 years since that balance sheet normalization process started. Is that appropriate in your eyes?
Well, I think that they're going to move much more quickly in terms of the end of taper and then the balance sheet normalization process. But that's because the economy is at a much higher rate of resource utilization and inflation is a lot higher. So I think the timing is going to be much quicker, but I'm not sure that they're going to move much earlier relative to where they are in terms of the federal funds rate. The FOMC minutes to the last meeting made it very clear that they still envision the federal funds rate as the primary tool of monetary policy. So if you believe that, then they're going to want to get the federal funds rate up a bit. So if there is a shock to the economy, an adverse shock to the economy, they can lower the federal funds rate to provide more monetary policy stimulus. If you remember last time, they didn't start to run off the balance sheet until the federal funds rate got above 1%. And I think that's what's going to happen this time as well. It's just that we're going to get to 1% federal funds rate much, much faster than we did during the last cycle.
What about this general idea? We heard from James Bullard, I believe it was earlier this week, and he kind of talked about this idea of a sort of passive drawdown in the balance sheet, the idea effectively that they just basically wouldn't buy back some of the stuff out there. And then that would be maybe a little bit more of a genteel way, if you will, of sort of reducing the balance sheet. What do you make of that strategy? Do you think that could work?
Well, I think that they are going to move it at some point to allowing the balance sheet to shrink by allowing securities to run off, treasuries maturing and agency mortgage-backed securities prepaying. That's going to happen at some point. But I don't think they're going to use that as their primary policy tool. I think they're still going to use short-term interest rates as their primary policy tool. If you remember last time, once the balance sheet normalization process was started, it sort of ran on autopilot in the background. Fed officials at the time talked about it. They want it to be like watching paint dry. So I think that what they said is the federal funds rate is still the primary instrument of policy. Once they get the federal funds rate up a bit, then they'll start to normalize the balance sheet. But I don't think they're going to use the balance sheet as an active tool to try to fine-tune monetary policy.
We, of course, are about to hear from Fed Chair Powell. We know his re-nomination is about to go through Congress. And I'm interested in what tightrope he's going to continue to walk, because it's quite clear, it feels very clear from the minutes, that inflation is the key concern. And rightly so, if we're pushing up at 5% or so. But they're also dual mandated, and also we heard this almost sort of third prong to that mandate that is not just about full employment, it's about inclusive employment, an inclusive labour market. Will he be forced to sort of put that to one side because of the impact of inflation on the same sort of people?
Well, I think what he's going to talk about is how the Federal Reserve is going to do their job and try to keep inflation from becoming a long-term problem. Because if they are successful in keeping inflation from being a long-term problem, then they can allow the labor participation rate to continue to drift up and get a lot of these less advantaged workers employed. So I think he's going to basically say that getting inflation under control will best achieve our objectives in terms of having more inclusive employment.
How are you thinking, and we heard this from St. Louis's Bullard yesterday, about the benchmarks that we're measuring these metrics on? He said yesterday, pre-pandemic benchmarks as it relates to employment may not be appropriate, as we're thinking about the labor participation rate, the employment to population ratio. Has something structurally changed for you where those pre-pandemic benchmarks no longer make sense?
Well, I think the Fed has been disappointed by the fact that the participation rate hasn't come back more quickly. I think there was a hope that with the end of the supplemental unemployment compensation benefits and back to school in the fall, you'd see a more rapid rise in the participation rate. That hasn't happened. It's hard to know exactly what's going on. Presumably some people retired early because of what they were seeing in terms of the economic environment. Other people may be still sick. I think long COVID is an issue that may also be having some lingering effects on labor force participation rate. I think the important thing here is the Fed is no longer counting on a rapid increase in the participation rate to generate more slack in the labor market. I think if you probably polled Fed officials today after this employment report, I bet most of them would say the Fed has achieved its objective of being at maximum sustainable employment consistent with price stability.
A final question, Bill, here, and this is once again back on the market here, and the idea of financial conditions and the perception about financial conditions. We've felt like we've sort of been here before, where the Fed tried to adjust rates, or adjust policy, I should say. There was a pretty severe market reaction, and the perception was that the Fed sort of pulled back in the face of that. I'm talking about back in 2018, the last time this happened. And I'm wondering if you think the Fed has a little bit more resolve, and more importantly, a little bit more data on its side to stay this course, even if there is a severe negative reaction in financial markets?
I think they're going to be less sensitive because they have a much bigger inflation problem. They're going to be less sensitive because they can see the consequence of a tight labor market in terms of wages. One very important report we're going to get at the end of the month is the Employment Cost Index, which already has showed significant acceleration in wage pressures. When we get the fourth quarter number at the end of January, that's likely to show even greater acceleration. So the Federal Reserve really does have the facts on its side.